Hello, everybody, and welcome to Wall Street Hackers, where we talk about investments, which everybody can use a little bit more knowledge in that area. And while we're doing that, before we introduce our speaker, I was doing some studies on the S&P 500, which everybody says, oh, it's great, I'm in the S&P 500, I'll just go to sleep. Well, here's the interesting study. By the way, you can do it yourself, okay? It's kind of an interesting study. I did it years ago, and it's really hard to believe. But riddle me this, Batman. Timing, I guess, is everything. If you started and you invested $100,000 in the S&P 500 in the year 2000, you put $100,000 in. Then you decide to retire in year 2009. So you have a 10-year history with the S&P 500. Your $100,000 is worth $75,000. You lost $25,000 over 10 years. It's absolutely horrible. But like I encourage our audience, go ahead and do your own study. Look at it. Investing in the year 2000, retiring in the year 2009 or 2010. You did in the S&P 500. You put it all there and lost money. Well, with that, we're going to bring in the hacker himself. He's a graduate of UCLA, where he received his degree in economics. He also has a law degree from the University of Miami, and he also has a master's in business administration from NYU. Spending 17 years on Wall Street, working with the Tower of Power of the money people to be, is the hacker himself, none other than Peter Bennett. Peter, hey, welcome to your show.
Thanks. Welcome, audience. Welcome, Nick. You can catch Wall Street Hackers most Thursdays or Saturdays, depending on your distribution channel. Once in a while, we take time off. The markets. Usually I do the quotes of the week after the markets, but this week, the quotes of the week so much exemplify what is going on in the markets. And I think by themselves, they're convincing. They're pretty reliable sources. So I'm going to tie the quotes of the week in with the markets. So we're going to start with a quote from Jamie Dimon. I've known the name Jamie Dimon since I worked for Wall Street. Even at the beginning of my career, I heard he was a really sharp person. Somebody who knew him or worked with him a little bit, an old boss of mine, was very complimentary of him. And so he's a sharp guy. So here's what Jamie Dimon, who is the CEO of JP Morgan Chase, said. He said, quote, I ask people in business, are you prepared for something like 7%? The worst case is 7% with stagflation. He's talking about interest rates. 7% with that stagflation. We urge our clients to be prepared for that kind of stress. He also said that he is cautioning a 2% rate hike would be, quote, more painful than the last two. This will be the tide going out. So what he's referring to is the famous Warren Buffett quote about, when the tide goes out, something like, you find out who's doesn't have a good ship or something. Sorry, I can't remember the quote, but basically you notice who's weak when the tide goes out and the economy is getting weaker. So that's Jamie Dimon saying it. And I don't know if it's going to be 2%, but we will be discussing that in our panel discussion in terms of where we think rates are going. And that's a very important topic. You think, well, that's kind of not so important, or to some people might look at that, might be boring, our rate's going to 6, 7, 5, whatever. But the thing is, if you knew where rates were going, you could predict what the market's going to do. And also, if you knew when rates were going to do it, or, with a sequence, you could predict how to invest in the market. So it's critically important for the investor to at least take an educated guess at what rates are going to do and to prepare for different scenarios. So we've been talking about rates for, all the reasons we think inflation's out of control for about 1.5 years now. So he's just saying what I knew, a long time ago. And he's only talking about really one or arguably two factors in this. I don't know if he talked about others because I never read the whole transcript of what he was saying. But the point is that he's talking about Fed rates maybe going up. He's talking about, Fed rates maybe not being too high and inflation rates. But let's look at the other factors that we've been talking about also for a year and a half. Number 3 factor is unemployment is still near a 50-year low. And the last time it was so low was when we had the 70s, and that was a huge period of inflation. So here's a quote from Barron's Daily, just on 9/22. The surprise decline in weekly jobless claims to 201,000, the lowest since January, that's not a good sign, suggests the labor market is still hot. After the Fed's economic projections Wednesday showed interest rates staying higher for longer, the labor data further solidified that concept for investors. So yes, that's one of the 3 problems, the labor market, and it's out of control in terms of there's people who, if there's that much demand, people will demand more, and they're going to also demand more as the Fed's creating the cycle of, well, if inflation is at 5% or whatever, then I need a raise of that plus more. And then we get to what I always call the bull in the china shop, and that's oil. And that could be driving the whole thing, or a lot of it by itself. And that was the major problem in the 70s. But here's what Doug Lawler, who is the CEO of Continental Resources, said. Continental Resources is one of the big producers in the United States. And he said, without new exploration, quote, you're going to see $120 to $150 oil. You're going to see more pressure on price. That's going to send a shock through the system. Yeah, that alone is going to be a shock. And you add to that, he's predicting that unless government adopts new policies, we're going to be discussing that in a minute, but if they don't adopt new policies to encourage more exploration, he thinks it's going to climb as high as $150 a barrel, maybe even higher. We'll talk about that too. So you add that to the fact U.S. oil production has now fallen off since hitting a high in July, and it's the 3rd monthly decline in October. Now, oil is high. As a matter of fact, it hit around 93.68 yesterday, which was the high for the year. But production's going down. That's not a good sign. There's something structurally wrong. And this is the real problem. And I talk about this all the time. Everybody in government should be scared about this because there's a huge structural problem. It is the following. Oil and gas companies are putting in an estimated, and I think it's a reliable estimate, give or take, 40% too little capital into oil and gas projects to maintain oil production where it is. That comes from USAC, a former investment. I'll look at it again sometime maybe. But they're experts in the field, and they said that. Now, you might not believe them, but all you have to do is look at the actual investments of the oil and gas companies. So until 2015, they were putting in a lot of money. As prices came down in 2015 and there were changes in the industry, and now they're putting in less than half what they used to do every year in terms of new investment in oil and gas projects. So why is that? Well, you can figure out some of the reasons. Governments in the United States and the world have a theory that if they can crush oil production, that everybody will switch to solar, which is not really reality because it's going to take a long time to switch. And by the way, they're hurting environmental causes a lot because their coal use in the world is the highest ever because people can't get natural gas and oil because they're fighting everything. But the second thing is oil and gas companies are now spending 10%, which is a huge amount of their budgets on ESG projects like carbon sequestration. That 10% is not going to oil and gas actual production. And the third thing is, if they think they could even be in a terminal business in 20 years, which I don't think they will be at all, then they're going to be cautious with their capital. They'll maybe raise dividends, maybe not invest as much. If you were going out of business, you don't want to invest until the very last day. So with all these factors, oil and gas production is likely to fall way short in the future. And here's the key. And that gets back kind of, if I can explain it, back to the CEO of Continental Resources, which said, well, government needs to adopt new policies soon. But here's the problem. These projects are 5 to 7 year projects. So when you start it up, you have to, find the oil. You have to start, it's a complicated process. I'm not going to go into it, but it takes 5 to 7 years. Even once they start drilling, it takes years to get the project up all the way to full production. So let's say all of a sudden somebody in government or somebody in the world figures out, and I'm sure somebody's figured out, but in general, the people figure out, wait, we're really short on oil and we need this oil and prices are going too high. Well, they're not going to be able to say, oh, okay, next month we're going to double our production because it's going to take years. So this is a potential huge black swan, which you can look up if you don't know it, but it's an unexpected event. So this is a likely black swan, in my opinion. Sooner or later, if you don't invest in oil production, you don't get what you need. And I think it's going to happen. So it could be this year. It starts really hitting. But the long-term trends in inflation and the Fed trying to be longer for lower, well, higher for longer, and all these other trends, it is going to take some pain in the economy to get things under control. And we're going to be discussing that again in the final segment. So 5 most interesting stories of the week. Number 1, I've given up on trying to stay away from politics because even though, I have some problems with issues on both parties, but the thing is, it's just too interesting and it's too relevant. So it was kind of surprising, but the Washington Post, which is a very liberal paper, totally liberal, ABC News poll, ABC is the same, has had Donald Trump up over President Biden in a hypothetical match, 52% to 42%. Well, this said 9%, so it must be a rounding error. But so they have Donald Trump up 40 by about 9 or 10 points. There's so many points from this. Number 1, the Republican candidates who are running against President Trump, their strongest argument was and is, I'm more electable than Trump, because people like Trump. They probably like a lot of the Republican candidates too. But how are they going to argue that I'm more electable if now it seems clear that Trump is very electable? Number 2 point, the Democrats have very few alternatives for President Biden, and time is slipping by. So Gavin Newsom is not a great candidate. First of all, he's got some real baggage from California. San Francisco is basically collapsing, among other issues in California. But also, I don't think he's going to want to run, even if he could, because I heard an analysis that said he'd probably wait till 2028. Why? Because the Republicans will be strong in the next election, and then he can run against a president instead of, if it's a Republican president. So, and he's young, he can wait, buy his time. Another point, the media has caused a disaster. The liberal media, most media is very liberal. And if you're liberal, you may not like that, but it's true. You should compare, cross-check. Admittedly, Fox News, I watch more Fox Business, but, they definitely have a slant conservative, but as much as they're to the right, the liberal media is like 98% generally, I'd say, to the left. They're further to the left than Fox is to the right, although they're both slanted. So the thing is, the liberal media has really hurt the Democratic Party by covering up stories about issues with Biden, as an example, of the fact that, to me, it's 100% that he has 20 shell companies. His family's taken in $20-50 million dollars, that there was influence peddling. He denied that he even knew about Hunter's actions when there's tons of evidence coming now, phone calls, and he used 5,000 emails using pseudonyms. It's a little suspicious, right? So if the media had exposed this earlier, or some of the other issues like open borders more, then those people who are watching only liberal media would know more, and maybe they'd have a better candidate, bottom line. So they really hurt the Democratic Party. It's not right that they do this. And I think they do it for ratings, give the people what they want, maybe whatever. And the final point is, this is just a prediction, but I think on the Republican side, I could see that it'll likely be President Trump as the nominee. And then he's probably going to pick, my guess is number one, Kristi Noem, and he'll have a female running mate, the governor of, I think it's South Dakota, one of the Dakotas. I'm pretty sure South. And then the other thing is, if not, maybe Tim Scott, who's a minority. And either one will be even more formidable because they are really eloquent speakers, and they'll be able to speak to segments that maybe Trump couldn't reach. So it's going to be trouble in the next election. Number two, interesting story. So Target Corporation is closing 9 stores. What a coincidence. New York City, Seattle, two locations, 3 in San Francisco and 3 in Portland. Basically, like 4 out of 5 most liberal cities in America. You can throw Chicago in there too, all run by Democrats. And the reason they're closing all these stores is because of violence at the locations, theft, and organized retail crime. Why is that they have these problems? Well, it's so strange, but it gets back to liberal media again. If the liberal media would cover this more, these pro-crime is what I call it. They're certainly very liberal towards crime. Policies wouldn't be in these cities. But these cities, especially San Francisco, is practically going to collapse. I mean, but all of them, they're losing businesses, they're losing residents, they're losing people who can move out in different, to different extents. San Francisco is a just total disaster. But all these problems have big problems, and it's of their own making, and it's the media partly that is feeding it. Number 3, sort of related. So New York Governor Hochul says she now supports nixing New York City's right to shelter law. So basically, for years, New York was a sanctuary city and state, and Mayor Adams himself has been pushing to suspend that law. Why? Because they have 125,000 illegal immigrants. They're having huge budget problems. They may have to cut their budget by 5%. They will have to cut it by 5%. And Mayor Adams says he expects 15% budget cuts for the New York City budget. That's huge because they can't support it. And so all of a sudden they're changing attitudes. And it's really frustrating in a way that, and I don't know how they could do this, but for years, Texas and the border states have been living with this. Some of these border states have towns of 60,000 where they have more than 60,000 illegal immigrants in there. But now, all of a sudden, now it's like a problem because it's affecting them. So it's just frustrating that the people, the whole border situation. Number 4 most interesting stories. A doctor working for the U.S. government visited the Wuhan lab in October 2017, about 2 years, they say exactly 2 years before the COVID-19 pandemic. He sent a report to the U.S. State Department, which said that they noted the lab has a serious shortage of appropriately trained technicians, and investigators need to safely operate this high containment laboratory where they were doing risky research on bat coronavirus. So 2 problems are pointed out here. One, I could never understand as soon as I heard this. Why was the U.S. and Dr. Fauci particularly, because he was the one who was actually doing it, funding a Chinese lab to begin with? Why are we giving money to China to do research on this? We could do it ourselves and keep the money in stock, but we just throw money around. The second thing is it was incredibly incompetent to ignore these concerns. Had they actually paid attention to the lab that they were funding, they probably could have prevented COVID to begin with. So, and finally, a different story. This is a story out of science fiction movie for sure. It's pretty interesting. NASA landed a spacecraft on an asteroid that has a potential to hit the Earth, but it's unlikely in about 200 years. The asteroid only has a 1 in 2,700 chance of hitting the Earth in 2182. So it's unlikely, but it could, it's a real long shot, but it could. So this is really important. And what they did is they gathered samples from that. So it's just amazing how science advances in so many ways, in so many positive ways, and so quickly these days. So we'll take a quick break, and then we'll talk about the dividend pick of the week and our panel discussion. So we'll be back very quickly. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Quillette. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
And we're back. So what to do? One, it's the same thing we've been saying for a year and a half. You have to be very defensive. There will be a time to come out of and maybe more aggressive, but I don't think this is it. Nobody can say for sure, but I don't think so. Number two, I believe you have to own energy, especially pipelines. And this week is one of the few non-U.S. energy pipeline picks that I'm going to discuss. And three, whatever allocation you have, you should always be in dividend stocks. I usually hold up the chart, but we've seen it so many times. Basically, the chart shows over 50 years. If you put money in the S&P 500, you had a very nice return. $100 from 1972 turned into $4,000, which is huge. But if you put it into dividend stocks, then you made over $8,000. And if you put it into dividend growers and initiators, you made over $12,000. So whatever stock allocation you have, and that depends on your financial situation, you should own some dividend stocks and not just stocks that are floating around with the market and don't generate income. So in income pick of the week, our disclaimers, there's no guarantees. It's just our opinion. Nobody can guarantee anything in the market. Even a CD is subject to inflation risk. And then it's for entertainment only. Consult your financial advisor. So this week, we're going to go over Kimball Royalty Partners Limited Partnership. And I've done that before. Kimball is, I was at 2% allocation, but I just raised it to 2.5%. And I'm going to explain why. They're an oil and gas partnership, but they're very different than the pipelines because they actually pay a dividend, a regular dividend, which I assume is subject to regular dividend qualified income, but I haven't actually checked that. But what happens is with them, if you have it outside an IRA, the last distribution I looked at was 3/4 return of capital and tax favored anyway. So you're not paying tax on if it continues anywhere near there. And also it's good in an IRA potentially because you don't have a UBTI issue. And that you can look at. But if you have too much limited partnerships generally in there, if they're master limited partnership, it can be a problem. So what do I like about Kimball Royalty Partners? Number one, they own huge tracts of land in the United States. I think it's about 16 million. It is 16 million acres of land, which, if you look at a map of the United States, you can see it. And also They have 125,000 wells right now. They've been very smart over the years in producing, and in the last period of time, they made a very smart acquisition. They often grow by making acquisitions, which gives me a footnote. They just did, and you'll have to look this up, a shelf registration where they could issue more shares. And I thought it would drive the stock down today, but actually it's up, but that could be manipulation too. But the thing is, that means that they could issue a lot of shares, so it might drive the price short-term down. But then they take the money and they reinvest it in some oil company, oil land. And the last time they did this, it did drive the stock down $1, but then it's back up again, and they made a great deal. So who knows? But in terms of when they'll actually do the offering, but now they could offer a very large offering. So if you see a little volatility, that's it. But you never know when to get in. But I like it for a 2.5% allocation. So what do I like about it, especially besides the fact that it's oil and gas, which I believe, and it's on land, it's mostly not in the ocean. So that's the best oil to get. It has an 11% yield. Some analysts are predicting it might go to 13% next year. The price to cash flow is either 9.5% or 7.5%, because I looked at TD Ameritrade and E-Trade, and they had different ratios there. But either way, they're covering their dividend. And this is the key point. Oh, and their sales growth rate, according to E-Trade, was 38%. So it's obviously a good time to be in oil and gas for last year. But this is an important point. You need some hedge in your portfolio if you have stocks. And it maybe even you could argue against bonds or anything, because let's say oil and gas goes through the roof, inflation goes through the roof. Well, that's where you're going to make the money, but it's going to hurt everything. Even the defensive stocks I have suggested could go down a bit. Some have gone up even in this environment, but some have gone down a little. I haven't taken any big hits, but I've also got almost most of my stocks in energy. So, but little allocations to another non-energy stock, you can't get that hurt anyway. It goes down to 10th on a 0.25% allocation or 0.5% allocation. But it's a very good hedge for the future. And there's a decent chance that if you're getting 11% a year, whatever, 9-10 years, you've gotten pretty much all your money back or close, depending on taxes. And then you just ride it out, because oil is probably going to be around for the next 20 or 30 years, I would guess, unless there's a huge scientific breakthrough. So, panel discussion of the week. Again, this is very important in terms of how to time the market, when to time the market, and what's going to happen to the market. So, how high will rates go, and how high could they go? And quick background, we have the Jamie Dimon quote. He was talking about 7% rates. The Fed rates now are about 5.5%. They said they may raise it a 0.25 point or maybe potentially more. The market, by the way, has the market rates going down by next year, but they were wrong all along, and they were wrong about the fall. It's not going down this fall. It's going up or staying flat. I have a personal theory that there's no, if there's no economic pain, there's no gain, because people have to change their behavior. In other words, if you are buying the same things and consuming the same products, you never adjust at all. You're traveling, you're driving, whatever it is. And also, if you're not, your job, maybe you're not working now because you can afford it or only working part-time, whatever it is, you have to change people's behavior. And we're not there yet, obviously, based on everything. So on the other side, the Fed believes that even if they just keep this now rate, and they could be right too, the Fed believes if they could just keep rates here, which have been raised a lot over the last year. I mean, we're looking at, 2.5 now to 5.5. That's a shock. It should be a shock to the system. The system has nerve. But they believe if you just go longer with these rates, that they're going to wear down the economy, things will turn around, and they could be right too. So the question for Nick is, who's the panel today? How high do you think rates could go, and how high rates would you guess if you were guessing?
7% is very reasonable.
Really?
But see, the thing is, we have a problem in this country is how long you've lived and what decades have you lived through. And to give you an idea, if you lived and you were investing, you're in the market from 2010 to 2020, all you saw was low interest rates, as we well know, high stock market. So in your brain, you start thinking the market always goes up and
Right.
interest rates always stay down. Now, I completed a study. I had to redo the numbers because I couldn't believe it the first time that if you invested in the year 2000 in the
Right.
stock market in the S&P 500 and you didn't get the dividend stocks, you just went to the S&P 500. After 10 years, you have lost 25% of
And let me throw a little footnote in there, and then you can continue. The
Yeah, sure.
footnote is this was not even a time when there was an oil crisis or rates were rising. Rates were falling steadily during the 10-year period. It was actually after the dot-com bust when all of a sudden people just got too exuberant, like it could or may not be in tech right now because there's a big tech, enthusiasm. Although these companies are more solid than the dot-com bust, but and they could be fine. I mean, if I had money that I could wanted to speculate with, maybe there. But the point is, there are periods when there's a market can be very risky. And you're right. It depends what decade you're talking about and how old you are. Go on.
Yeah. Okay. So now we're going into this next decade. Okay.
Right.
We're already in it. And 7% is not really unreasonable. When I bought my first home, I was very fortunate. I got an interest rate of only 10%. And I felt great because 10%
Yeah,
was
I remember that.
wonderful.
Yeah.
And the second home I got was less than 10%.
Right. Right.
But 10% was a reasonable amount of interest to pay on a home, not this 1 or 2%. Well, you know what? It could be 7% for a long, long time, Peter. And the thing is, the real estate market is being hammered right now because of that, because all the income buyers that are out there are dead. They just realize their income will not support, because right now we have high valuations and high interest rates on your money, and they can't match.
The sellers can't move either, so it's kind of locked in a high valuation because nobody wants to get a new mortgage either.
Exactly. So you're going to run in, as I say, you're going to live in interesting times. In the next 10 years, who knows? You could see an average of 7%.
Wow, that would be really high, but that could be true. I mean, nobody knows. That's a thing. If you knew, you could, like an option, you could just make an immediate fortune just if you were 100% sure. But so a few conclusions. One, the rates do need to be high enough that they cause changes in behavior. And there hasn't been really radical changes in behavior. Housing prices are down maybe 3% over the last year. People are still easily, there's tons of jobs out there. People are driving. If there's no change, it's like sort of like the law of inertia. If something's heading in a certain direction, then if no force impacts on it, then it continues in that direction. So you need some force strong enough to at least direct somewhat. And it could be longer, high rates at 5.5. But my guess is that that people will adjust to the 5.5. And there's so many ways that the economy can adjust. And we'd probably do a show on that. I mean, things like if you're getting a COLA increase on your Social Security, then if rates go up, inflation was 8, but you get an 8% increase, you don't really need to change your behavior. That's just an example. So my guess is, I think we're going to hit at least 6, because when we hit 6, and let me take one footnote. There's another important point, which is there's always been a debate. Does the economy lead the stock market or the stock market lead the economy? And nobody knows the answer to that because you can't prove it, but it's probably a bit of both. So unless the stock market goes down, the economy, people aren't going to change their behavior because I have lots of money in the stock market. A lot of people, I'm making money, whatever. It's just another reason. But if the stock market goes down, that would be another reason. So my guess is there has to be a rate that the stock market is going to go, holy cow. And then that and plus people start changing their behavior, and unemployment unfortunately will go up. Unemployment will go up. So my guess is minimal of 6 is a guess, and I wouldn't be surprised if we hit a max of 6.25 to 6.5. I think if we hit 7, it's going to totally crush everybody. But you know what? It's not a question, Nick, and that's the thing. The only point I know is that the market is delusional, because the market's been delusional for the last year and a half. Rates are going to go down now. Rates are going soon. We're going to have a soft landing. Everything's going to be perfect. In the fall, rates are going to go down. Now a few weeks ago, they said rates are going down 1%. Now they think it's going down 0.5% next year. I don't even think they're going to go down probably next year at all. I'm concerned if they even go up. So the bottom line is be defensive, own oil, own energy, and and we'll wait till the time seems right. But the market's now in the same level it was in June because of everything going on. So we just lost 3 or 4 months of gains, but it could go a lot further. It could easily hit another low back from a year ago because it had a nice run up. But the economic conditions are not saying to me that it's a bullish market in terms of the fundamentals. Technicals, hard to say. So that's it. We're out of time. Thanks for watching. As Kim always says, get healthy, get wealthy, and we'll see you next week.
Bye-bye.
Bye-bye.